Hello, and a very warm welcome to the Property and Investor Podcast. I'm your host, Paul Lanfear. As you know, my inner lawyer needs to say a few words before we get into the podcast. Nothing in the podcast is health, legal, or financial advice. We are going to cover some regulated ground today, almost undoubtedly, and neither myself or my guest want to get in trouble with the FCA. So, just to re emphasize that warning, Antoine, welcome to the podcast.
Thank you very much for having me.
Now, you're one of the co-founders of the Investables, and we're going to get into that in due course. But the subject matter of today really follows on from a discussion I had with, a mutual friend of ours, Ro, in terms of raising finance and building relationships. And it seems obvious from our conversations afterwards that this conversation was the logical next step. So I'm really grateful for you coming on the podcast.
No, yeah. So I listened to the podcast. I listened to your chat with Ro, and you touched upon, quite a few very interesting points. So yeah, I'm quite happy to do that follow-on podcast to dig a little bit deeper into the topic of raising finance ethically.
Yeah, absolutely. And I don't know whether we touched upon this before when we were setting up the podcast, but I remember a many years ago, I attended a crowdfunding boot camp conference, all things crowdfunding. And you and your fabulous life and business partner presented there, and you did a really fantastic job. So I'm really thrilled that you've come on the podcast. Now, you have got a very interesting background as an FCA authorized person in the context of investment banking. So I'd like to start there because it is really relevant and it feeds into discussions we'll have later in the podcast. But do you want to talk to us a little bit about your career in investment banking?
Yeah, absolutely. So I was formerly FC authorized. It's no longer the case. But yeah, so I worked in investment banking for a number of years. Started in Paris, then worked in New York and London. And when you talk to clients in finance, you have to be regulated. You have to follow a certain code of conduct, which means taking exams and the regulator and your employer just making sure that you are fit and proper to operate, in a highly regulated environment. So yeah, I had to go through some of the FCA tests, and I had to do the same in the other locations I worked in. So the FCA equivalent in Paris and in New York as well. But yeah, that was my job for slightly over 10 years. So sitting on the trading floor, talking to my clients, which were, a mix of businesses. I started talking to asset managers and large corporations, and I ended up covering central banks in the later part of my finance career.
Mhm. Investment banking always strikes me as like one of those jobs, a bit like my former career of being in the law. Like it can be an absolute thrill in your early 20s and into your 30s. But perhaps for some of us, we come to our I'm going to say come to our senses, Antoine, but maybe that's putting it too high for you. But a point came where you, and I imagine the same as with investment banking, presumably you're doing very long hours, reasonable amount of pressure, and etc.
Yeah, I mean, it was a high pressure job, like a lot of other jobs, out there. And I think you hit the nail on the head there. I reached a stage, so it was all very exciting when I was in my 20s and early 30s. And then when I hit like early to mid 30s, I looked at my managers and I didn't see myself in them. I was like, I don't want to be them, 5 or 10 years from now.
Mhm.
So I got to do something else. And,
That
that's
is
when
so,
like property kicked in. Yeah.
that is so interesting. That's really, really interesting. I had a similar experience with an executive coach I was appointed in a law firm. She asked me kind of who I most admired, and I have to say I had a lot of respect for the people I work with and continue to this day. But I didn't admire kind of what life looked like. And some of the challenges that they had to deal with on a daily basis. So it's interesting to hear that from your perspective. So how did you do the transition into property?
So I knew nothing about property, like literally zero. I had
Hmm.
never invested in property. I had never even considered investing in property, but my wife and business partner had. So she did the whole property education thing back
Hmm.
in 2014, 2015. And she slowly transitioned from being full-time in compliance. So she's got a legal background. So she slowly transitioned from being full-time in like legal works to investing in property. So
Hmm.
hands-on first. So she did her first project, and then she did a bit of a consultancy work for developers, platforms, prop tech companies as well. And just like slowly, gradually went from a cushy 9 to 5 to a more exciting, and you get more free time and all that, venturing into the property space. And that's how I find out about property through her. She
Hmm.
showed me how exciting investing in property can be, how interesting the space is, how varied the backgrounds of the people that you meet in property are.
Hmm.
And I was hooked, and I saw it as my way to exit finance,
Hmm.
which, I mean, I can't be, I'm very thankful and very grateful for what finance has brought to my life.
Hmm.
But it was the right time to do something else. And yeah, that's how I discovered property.
Yeah, that makes sense. So did your wife do the become a barrister first and then go through the conversion process to become a solicitor?
So she was dual qualified, so barrister and solicitor, like right from the start. But then she didn't actually practice as a lawyer. So she went into financial compliance right from the pretty much right from the start,
Got you.
and worked in financial services. So we worked next door to each other,
Oh,
basically,
fantastic.
for two different financial institutions.
So you're clearly people who like to sit a lot of exams. Hopefully those days are behind you, but who knows? Um,
I wouldn't
y-
say that I like that, but it's part and parcel of the job. I guess you have to do it.
yeah,
Otherwise, yeah, you can't.
it
You can't.
that's definitely true. And I mean, look at us all now. Like we're all pretty much continually doing continuing professional development, just in a different context, aren't we? And we're kind of used to that's just part of life and part of growth, which is why we're doing podcasts and all kinds of
Mhm.
interesting things. There's something that you said that was really interests me because I rarely hear it elsewhere, but I heard you speak on a previous occasion, and uh, if I'm misquoting you, you must correct me. But the gist of what you said was, we were working on property, and actually what we discovered is we had more fun or engagement actually not by being hands-on in property, but by investing in other people's projects. Can you just talk around that for a moment or two?
Yeah. So my wife did one project of her own,
Hmm.
and she realized quite quickly that being hands-on wasn't for her. She just didn't enjoy it like she did. It was a successful, profitable project, but she didn't see herself continue doing that for the foreseeable future. And it was never a consideration for me to actually be hands-on in property, because that was just too big of a step at this stage, and I just didn't have the inclination of the desire to learn all about property. I just wanted to get to a stage where I was comfortable, and yeah, so we were never interested in doing property ourselves, doing property projects ourselves. So it seemed logical to instead be investing in other people's projects as hands-off investors, because it works really well given our skill set, our experience, our backgrounds, and it was just, yeah, exactly what we were looking for, right? We were looking to make some money
Hmm.
by investing our cash,
Hmm.
and not wanting to be hands-on but being hands-off. So yeah, investing in other people's projects made a lot of sense.
Yeah, definitely. And I find that really interesting because in my conversations with people who have, for example, sold a very large business, they've had like an ongoing professional career and they've acquired capital, or for family reasons, they've kind of acquired capital at a certain point in their lives. And they're talking to me about, what do you think about property? What do you think? in relation specifically to those people who are very, very liquid and are not necessarily, looking to get into like the real like nuts and bolts of it. The first thing I always say is definitely consider not investing in property in the sense of, doing it yourself. You would be much better off um, uh, investing in other people's projects if you can do it sensibly, ethically, manage the risk, understand what you're taking on, and or exploring, other investments. It's it isn't for the faint-hearted, and it's definitely not, I would say, not for everybody. And I would say if people are particularly liquid, um, and they perhaps want to enjoy part of the rest of their lives. So there are other things to do, aren't there? And if really what
Yeah.
you're really looking for is a yield on your capital and to enjoy the finer things in life, which could include like grandkids and that kind of thing, then um, I think investing in projects is like the last thing to do, personally.
Yeah. I mean, look, there are a lot of people like us, we're interested in being hands-off investors, a
Yeah.
lot of them. And as you said, for various reasons.
Mhm.
Because they don't want to be hands-on themselves, because they're too busy, because they don't have the knowledge, because maybe they've done it before and now they want a more comfortable lifestyle, loads of reasons, and
Mhm.
therefore loads of people that,
Yeah.
that as a developer, you're looking to attract to raise finance for your project.
Yeah, definitely. I would say a big one on that list currently, right now, are people who've been in property for a long time who have sold parts of their portfolio, because they know how it works, but, they don't want to get back into the trenches. And so, they're actually quite happy to, invest in other people's projects if they tick all the boxes and, make the yield in that way rather than being like directly kind of in the frame of it. So, you,
I'll just touch upon that because I think it's a great point. And people who have sold their portfolio, and it's definitely a great target when it comes to looking for investors, but also people who are in between projects.
Mhm.
If you take on a really large project that's gonna really, take a lot of your energy and time for, say, a year and a half, 2 years. Some developers just want to take a break. They make good money on a project,
Mhm.
and maybe before they jump into their next project, they're going to be looking for somewhere to park some of their cash. And that's
Mhm.
also a great target for people looking to raise private finance. Other developers in between projects with some cash to spare for a little while.
Yeah, absolutely. And I can speak directly to that. I have been in that boat. I have been on both
Are
sides
you?
of this table. And that's exactly the reason that we deployed capital in that way, taking a break, working on a different business. There's all kinds of things that we have on our desks, isn't there? Okay. So then I think we've got a shared motivation in this podcast to guide people as best we can in what is a difficult area, insofar as I think people are um, encouraged to do things which may not be necessarily in their best interest. And there's no like hint of criticism or no tonality in that statement. I'm just trying to make the point that a lot of the stuff we see around us doesn't work necessarily for one reason or another. And well-intentioned, good people with good values are, find themselves in a difficult kind of position. So if we would like to take this right back to the beginning, like what if someone, let's assume good values, reasonably competent at what they're doing, want to make progress, doing it for all the right reasons, really care about their investors. So they've ticked all those boxes. They're just getting started in this process. What is the starting point?
So what is the starting point? Starting point is getting ready,
Okay.
getting ready to raise private investor finance. And it's not, from just like you wake up in the morning, you've got a project fund, and you're going to call everyone you know and pitch them your project. That's not how it works. Two reasons: it's illegal to do it this way. And second one, it's not going to work. And you're going to push away so many investors, so many people who could potentially help you by doing that. So I guess the first step is getting ready and understanding what raising private investor finance is all about. So
Mhm.
the regulatory side of things, but also the relationship side of things. You're not it's not just about money. It's people getting to know each other, trusting each other. It's a relationship business. Property is a relationship business. Investing in other people's projects, even more so. So it starts with that, understanding that it's a process that you're getting on, that it's not going to happen in just a matter of a few days. Okay. It's going to take weeks or months to get ready to raise private investor finance, depending on, what you've done before, how advanced in the process you are. But yeah, I would say that's where you start, try to really get to the bottom of how things work, get ready to put yourself in the best position to go about raising finance.
I think it's very interesting that you flag towards that question of like what people have done before. I really feel like that's overlooked in the space, is that people overlook the value they already bring with them, in terms of what they may have done before. So let's say you were a very accomplished project manager, for example. That brings with it enormous value. It's definitely not irrelevant. It should definitely be put on the table, I think. Um, I suppose I'd add, uh, also that I think va values are important as well. I think it's important to be clear on your values, because whether we like it or not, we're always communicating our values, and that will come through all of your communications, all of your meetings, probably
Mhm.
the documents you produce, because we're always speaking our values in a way. Um, the two fascinating points you raised there. I don't know which one to click on first, really. I suppose the illegal one, which is obviously the big one, but also the relationship one. So if we look at the relationship one first, um, Roe, obviously, this podcast, as we've discussed, follows on the conversation from Roe, and Roe talked about that, building relationships over time. An interesting piece of feedback I had from a female angel investor about 2 years ago now. She said, what's really interesting is when I go to property networking events, people talk at me, and they just talk at me, they pitch me, they talk at me. She said, it's really fascinating. Nobody asks me a question. Nobody asks me what I'm looking for. And she has stood there, and she's very liquid. And like, I mean, liquid. She's got literally the money in the bank ready to go. And she's also motivated to invest. But yet nobody asks her what she's looking for. So can you speak a little bit about that? Like, how do you genuinely get to know investors? How would you approach that?
So I'll tell you what doesn't work, and I think the example he just provided is perfect. It shows exactly what doesn't work. Like pitching to somebody, pitching a deal, leading with a deal is not going to work, because it
Hmm.
doesn't matter how exciting, how wonderful your project looks like. No one's going to invest in you until they don't like and trust you, right? I think that's the term that's often used, and that's true. That's exactly what it is. Um, and so exactly when we go to networking events, we see people pitching. They talk about, oh, this is the kind of return I can offer. This is the kind of money I'm looking for, but they're missing the first step. Like they're going for they're trying to close the deal before they've even started building a relationship with us, the investors, and they're also not doing their DD on us. Due diligence is a
Hmm.
two-way street. When you look for investors, investors are going to be wanting to do their DD on you, but
Hmm.
you should be your DD. You should be doing your DD on the investors as well. Not everyone is going to be right for you. You were talking about values earlier. You
Hmm.
probably want to some common values, because that's how you can build a relationship more easily. If you have same values, and people forget that a lot. So yeah, relationship first,
Hmm.
and later down the stage, later down the line, that's when you start talking about deals, talking about money and all that, but not right from the start, because otherwise you're going to push people away, and a lot of the time without even knowing it. You talk about
Hmm.
networking events, you don't necessarily know who's an angel investor, who's a private investor in the room, because they're not going to make that obvious, not going to stand in front of the room and say, oh, I've got some money to invest. They're
Hmm.
just like talking to people, And there you are, maybe doing your 20-second shout out or 20-second pitch. And all you say is, oh, I'm looking for investors, I'm looking for this much, I'm offering that much return. No one is going to go and talk to you after that because you're too transactional. You're talking about the deal already. It's too
Mhm.
early. Build a relationship first and, take time to focus on that first. And maybe you have an opportunity to pitch later on.
I totally agree. And there is this concept, isn't there, that not everybody's money is equal. And what I mean in that respect is that there are people who are easier to deal with, and also, you do want to be mindful of like source of funds and what what activities has this person embarked upon to raise their capital. In regulated industries, so for example, well, obviously my former industry of being in the law, money laundering was absolutely the most single important thing. If you were not to follow the money laundering um, process, you would not have a job. I mean, I think that was
Mhm.
probably you could be summarily dismissed. I'd have to go back and read my contract, but that was an absolute non-negotiable. People wanted to know, is there a conflict of interest? Have we complied with all the money laundering process, even before you could really have those first detailed conversations because well, for all kinds of obvious reasons. Um, so let's. You mentioned the danger of committing illegal acts, and unfortunately, this is an area where it is actually possible to commit criminal acts, believe it or not. I mean, which is
Mhm.
I don't think people fully anticipate. So this is a complex area, so I think let's deal with it initially at quite a high level. So, what are the regulatory challenges, hurdles, or things that people listening to the watching and listening to the podcast need to think about from a regulatory perspective?
Yeah, so I think what's really interesting about the regulatory landscape is that it follows what I just said about building relationships. The interestingly, the way regulations, the rules were designed, very much follows the relationship focused approach. So building the know, like, and trust with investors prior to pitching, prior to promoting a deal. And so if we are a little bit more technical, you are not allowed to ask for money um, until you have asked investors to certify as exempt. And there are two categories of exempt investors, so high net worth, or two main categories rather, high net
Mhm.
worth and sophisticated investors. And the idea is that you can talk to people about, who you are, what you do, your experience, what you've done in the past, your backgrounds, who you work with. But once you stop pitching, you must have made sure prior to pitching that the people that you talk to are high net worth or sophisticated investors. And
Mhm.
when I say talking to them, it's not just having a conversation with them. It can be in an email, it can be a social media post, it can be being in front of the room at a networking event, it can be on a podcast, so on and so forth. So yeah, the rule is really build relationship first. When you start pitching, you have to make sure that the people you talk to, that you're pitching to, are the right kind of investor.
Mhm. And then, so if we just kind of go a level deeper than that, then, so what would be, and I appreciate these things will change over time and people need to keep themselves abreast of the changes. So this is just, an indication at this current moment in time, but define or describe in outline perhaps a high net worth and how that contrasts to the other exemption of being a sophisticated investor.
Yeah, so the rules actually changed at the start of 2024, but they didn't change for very long because they got back to the old statement, to the old threshold, and the old definition of high net worth and sophisticated investors. But so for high net worth investor, There are two tests that an investor can meet to qualify as a high net worth investor, and you have to meet one of the two conditions. The first one is about net assets. So to be a high net worth investor, you must have net assets of £250,000 minimum. So that's one condition. And the other condition, and again, you only have to meet one of them. The other condition is annual income, and it's an annual income of £100,000 at least. So that's how you can qualify as a high net worth investor. So for a few weeks, the thresholds were raised, but there was a big hoo-ha in the fundraising industry. A lot of people pushing back, and they decided to revert back to the thresholds that I just mentioned. And the sophisticated investor, there are a few criteria, a few tests for you to qualify as such. I think the most important, or the most flexible one, which is the one a lot of people are going to use, is having made at least two investments in unlisted companies or in unlisted securities. I think in the past year or in the past 2 years, I can't remember. We need to look at it in detail. But it's a very, very flexible criteria, especially given how the crowdfunding space has become so prominent in the recent past. So it's essentially a very easy way to qualify as a sophisticated investor. If you say you've made a couple of investments on a crowdfunding platform over the
Mhm.
past 2 years, then technically you are a sophisticated investor. So it's not that complicated, to qualify as one.
That is really interesting. And you can do funding platforms, you can do very small investments, like almost micro investments, can't you? I appreciate that some now have like big hurdles of, £100,000 and that kind of thing, but some of them you can actually make micro investments on, can't you?
Yeah, so you could make actually two £10 investments in two companies on the likes of like Crowdcube or some other crowdfunding websites platform, and you could call yourself a sophisticated investor, or you would be able to sign a sophisticated investor statement. And again,
Oh,
I was telling you that the rules had changed for a
yeah.
few weeks. That criteria was taken away, but because there was so much, pushback from the fundraising community, they decided to reinstate it. So we're back to the very, very flexible rules that we've had for quite a number of years now. So,
Wow.
if you ask me, there's no excuse to not follow the rules because they are very, very flexible, actually.
Right. That's very interesting. Um, and many people watching or listening to the podcast will be familiar with this because when they've gone on to, a platform of an institution, there's a limited amount of information on the website, and in order to get through to the stuff they really want to understand, they have to go through this process, clicking the buttons and all the rest of it. So this will be a process which is reasonably familiar with people. And if it's, I would say if it's not familiar to people, if they just go to look at some crowdfunding platforms or other financial services platforms, they will be taken through this process, and they can see how it how it works and what it means to them. Um,
Absolutely. And I'll add one thing to that, Paul, if you don't mind.
mhm,
Um, it's the process for an FCA regulated entity.
mhm,
The process for most property developers who are not FCA authorized is to rely on the exemptions that I just talked about. So promoting only to high net worth and sophisticated investors.
mhm,
Um, Relying on these exemptions means that you are not allowed to mass market your opportunities. You're not allowed to go on social media and say, "Oh, I've got this deal that I'm looking to fund. I'm looking for this much in investor finance." That's
mhm,
the big difference between the FCA regulated space and relying on exemptions that I just talked about. And that's where a lot of people actually cross the line into illegal territory. Um, they breach the FCA rules because they don't understand that. So there is a very flexible way to go about raising private finance when you're not FCA authorized. And that's what I just talked about, high net worth, sophisticated investors. But there are some steps that you must follow to do it in a legal way.
Perfect. So I think just stepping a step back from that. So the what we've discussed there is the methodology of building that relationship, know, like, and trust, taking somebody through a process of them understanding you, the business, perhaps past projects, if that, but then there being the red line, which is when you have to then formalize the process with them and have the self-certification process. Now, what you've alluded to there is really fascinating because it takes us nicely onto the next subject, which is financial promotions. Um, so you have just described what we see every day, which is I've got this project, this is the return, these are the numbers. You know, direct message me if you'd like to get involved. And it sounds from what you're saying that is going to take people into difficult waters. So why are those difficult waters? So what do people risk falling foul of by doing those ever-present social media posts?
So the topic of financial promotion, so yeah, that's exactly what we've been talking about. And so financial promotion is defined as an invitation or inducement to engage in investment activity. And the main point about the regulations is that unless you are FCA authorized, you are not allowed to make a financial promotion to just anyone and everyone.
Yeah.
You can only make a financial promotion to exempt investors, so high net worth and sophisticated investors.
Mhm.
So in other words, what does it mean, in your quest for private investors? So every time you post something on social media, every time you talk to somebody, if you haven't made sure that they are high net worth or sophisticated investors, it basically means that you cannot make a financial promotion.
Mhm.
So if you go, if you post on social media and you say, I'm looking for investors for this project, well, you got to ask yourself, is this a financial promotion? Is this an invitation or an inducement to engage in investment activity? So if you say, I'm looking for investors for my project,
Mhm.
it is an invitation to engage in investment activity, right? It couldn't be more obvious than that, right? So you cross the line. If you say, I work with investors and I offer them bank beating returns, guaranteed returns,
Mhm.
is it a financial promotion?
Mhm.
Yes, it is, because it is an inducement to engage in investment activity, right?
Mhm.
Guaranteed, bank beating, you're
Mhm.
inducing people to actually engage in investment activity, to invest in one of your projects. So
Mhm.
again, you've crossed the line. So every time you're thinking about posting something or telling someone something, you have
Mhm.
to you have to ask yourself, is this or could this be potentially regarded as an invitation or inducement to engage in investment activity? And if the answer to that is yes, then you've most likely crossed the line.
And something that you will have undoubtedly seen is that using terminology like learn and earn. Is there a risk that that falls within an inducement in this context?
As far as I'm aware, there's no exception or exemption for earn and learn investment opportunities. There are investment opportunities the same way that a hands-off investment would be with no, learning element. So you
Mhm.
have to abide by the same rules when it comes to promoting these investment opportunities. So yeah, social media posts promoting an earn and learn
Mhm.
investment would be crossing into illegal territory and would be breaching financial promotion rules. Yeah.
And what do you make of this is the final example I'll give you, and then we'll get back, I think, to the framework that we're looking at. Um, invest as little as, and then there's a really modest sum of money, and you very often see these on Instagram adverts that pop up in your feed. So, in the context of an unregulated firm, what would your thoughts? What are the possibilities around those kind of things that we see?
So from a regulatory standpoint, I think it's depending on what comes after the, invest for as little as, and the amount stated, it's likely to be a financial promotion. So you would be breaching FCA financial promotion rules. And on top of that, um, by using this kind of language, I think you're pushing away the savvy investors. You're trying to attract the small investors who may not know much about property investing, but at the same time, you're pushing away the savvy ones who actually know what property investing is about and who only want to invest in like solid investment opportunities. So by allowing people to invest very like token amounts of money or small amounts of money in your project and having multiple investors involved in a single project, first of all, you may be breaching some other rules, but that's not the point of this question. But anyway, by doing so, you don't offer any suitable security, any strong security to your investor. And that's what savvy investors are interested in, right? If they want to lend you money, they want to have
Mhm.
security, whether it's a first or second charge, a personal guarantee on top. If the loan is to a private limited company, or maybe, a debenture, things like that. And by allowing very small investments, you may think that you're making your job easier. It's easier to get, £10,000 from 10 investors rather than £100,000 from one investor. But actually, it's not. And you're not talking the right language to attract the people who can actually invest the 100 grand into your project. So to go back to your other question, don't do it. Don't say invest for as little as this much. And if you really want to lower the barrier to entry, use crowdfunding platforms. That's
Mhm.
what they're here for. They're here
Mhm.
to allow you to pool investors' money together, to get investments from investors who are not high net worth or sophisticated investors, and they enable you to actually manage the whole process
Mhm.
in a more efficient way because you don't have to
Mhm.
talk to each one of these 10 or plus investors. You're
Mhm.
talking to the platform, and then the platform talks to them. So it's where crowdfunding platforms provide a useful service to address this issue.
Yeah, it is really interesting. I never used a funding platform, although I have looked, a few years ago, I was looking at them. Um, I think it is a really interesting opportunity. If you think about a methodology, obviously you could do like one version is you kind of turn up at the platform and you don't have any kind of following or you turn up to the platform and you do it that way and you put in the work that way. Is there an opportunity to do it a different way, which is um, to uh, have a profile and to bring the herd, if you like, to the platform and the platform effectively to do the execution in a ethical and professional and compliant way so that you can in fact raise, let's say £100,000 from, let's say, 100 investors. I mean, I appreciate that might be a bit much, but I mean, is that a methodology that in this context you think could work?
So yes, depending on what platform you use, not every platform is gonna operate in such a way to allow this sort of process. But
Mhm.
those the platforms who do, absolutely, and it's a process, it's a path that we recommend developers follow because it works really well.
Mhm.
You're doing it legally. You outsource a lot of the compliance burden
Mhm.
to the platform. In terms of communication, as a developer, you talk to one party, which is the platform, and then the
Mhm.
platform talks to the investors, and it allows you to lower the barrier to entry, so you can
Mhm.
work with multiple smaller investors at the same
Mhm.
time. And who knows, these investors testing the water,
Mhm.
maybe on this first project with you, maybe they become direct investors for larger amounts in a
Mhm.
subsequent project, or invest more in your next crowdfunding project. But it's a great way. I mean, it's a great tool to add to your toolbox. Crowdfunding platforms, um, solves a lot of problems. Obviously, there are ways to make sure that you raise on the platform is successful. But
Mhm.
yeah, as investors, as private investors, we love platforms. They
Mhm.
allow us to meet people that we wouldn't meet otherwise.
Mhm.
And yeah, it's just a very easy way, very smooth way of investing, from first point of contact all the way to investing in a project and then getting updates. And, if all goes well, getting your money back at the end.
Hmm. Yeah, definitely. There's much talk of of return on investment, but I think every investor on the face of the planet is most interested in return of investment, preservation of capital. So let's take it. Appreciate we've made lots of progress already, and keeping one eye on the time. So talk to us a little bit about finding investors.
Finding investors. So I think, so although we use the term finding investors, you're not finding investors right away, right? You're not looking to find people who are going to say, on the back of one conversation, yes, I'm ready to invest in you.
Mhm.
You have to set the right expectations on your investor quest. What you're looking for is investor lead. You're looking for people who are investing in other people's projects or are considering investing in other people's projects or know people who invest in other people's projects and can introduce you to those people. And there are a lot of ways, lots of strategies to find investor leads. Some are free, but require a lot of time and effort, and some are paid, but are generally going to get a quicker results. So some of the free ones are talking to your network, reaching out to friends, family, not asking for money, but just about letting them know what it is that you do in property, how you work with investors, and either they may be interested in finding out more, the business that you're running, what you've done in the past, or maybe they know people who are interested in finding out more about all that. So your network always the first port of call when it comes to finding investors. Then on the free side of things, social media is
Mhm.
quite good as well. It's more of a slow process because you don't know a lot of the people that you are connected to on social
Mhm.
media. So it's going to take a while, to get to know each other, to get to trust each other. But it's also a really good way, to expand your network and get to meet other people. And then
Mhm.
if we move over to the paid side of finding investors, you have crowdfunding platforms,
Mhm.
full of motivated and vetted investors. And obviously, you have to pay a fee, to tap into this network. You
Mhm.
also have professional introducers that
Mhm.
you can tap into. And again, you would pay them a fee to get the introduction for them. And lots of other ways in between. And I think the key thing is you have to follow a few strategies, at the same time.
Mhm.
There's not one magical, way of finding investors. It's just implementing a few strategies, start with one, and then within a few weeks, add another one, and so on and
Mhm.
so forth. You gotta follow a number of leads, follow a number of ways to generate leads for your business. And over time, if you're consistent, you'll get the results.
Yeah, definitely. And I think I would add to that as well. I think there's perhaps a misconception that people need, an army of investors behind them. The reality is that you probably only need a handful of investors, if that, and if you build that lifelong relationship with them and you execute and perform well and you're honorable and you do the right thing and you take care of their interests above your own, very often I think you'll discover that people are happy to stick with you for as long as they possibly can. They might
Yeah, I
even
think.
be disappointed when you're
Yeah.
when you don't require their capital for a year or so.
Yeah, I mean, absolutely. Look, from our perspective as private investors, doing due diligence on developers is hard work. So
Hmm.
when we invest time and effort into doing our due diligence on you,
Hmm.
we want it to be worth it, right? We don't want it to be for just one project. We want it to be for several projects, over a number of years. And I mean, we get it, and circumstances sometimes change, and you
Hmm.
may not do a project for a little while, or you may do different projects. But the idea is that we want to build a long-term relationship with the developer.
Hmm.
And from the perspective of a developer, yeah, I think a handful of investors is a good start, because you want to have plan A, and then you want to have plan B and C and D, in case the first investor doesn't is not interested in the project that you're promoting. And also, private investors' circumstances can change.
Hmm.
So there may be, they may have cash, liquid cash now to invest, but maybe it won't be the case in 2 or 3 years' time. So even though you've got that little base of investors now, you wanna be constantly looking for more investors. Doesn't have to be 10 new investors every year, but just um, get those leads through your process, through your onboarding and nurturing process. And over time, they become warm and ready to invest in your projects, and they may replace some investors who just needed their money back, were not in a position to reinvest. It's a constant process, like finding deals, right?
Hmm.
Finding deals is something that you're not going to say, oh, okay, I'm going to spend the next week just finding deals, and then I'll be done for the rest of the year. It's not how it works. Yeah, finding investors is the same thing.
And then, assuming we've successfully found these investors, what thoughts do you have about the onboarding process? Like, what are some thoughts that we can share with people on that?
Yeah, so as I was saying earlier, due diligence is a two-way street, right? So the onboarding process is about making sure that these investor leads these people that you've come across, they're right for you.
Hmm.
You want to make sure that you gel with them. I mean, you don't have to be the same person, right? You don't have to agree on everything. I'll give an example. It's been the past few months have been very political, right? A lot
Okay.
has been happening in the political landscape, and I don't need to agree with you politically to invest with you,
Yeah.
right? So, you need to gel with someone, but the top values when it comes to developers and all that, it's more about professionalism and the way you communicate, and all that. But still, sharing some common values quite helps. So yeah, the onboarding is about making sure that you do your due diligence on the investors, and just understand what it is they're looking for, what it is they want, what they've done before in terms of investing. Just making sure that they are the kind of people that you would see yourself potentially receiving money from in the future.
Hmm. Yeah, definitely. Um, and it's refreshing to hear that perspective about, it's okay to have very different views to people. I would say that's probably regarded in this day and age as almost like a very traditional view, because that is the way it used to be. Is you would sit at a dinner table with like 8 people, and uh, nearly everybody would have a very different perspective, and there would be people on like absolutely, you know, different sides of the fence, but you would just have interesting, often animated debates with them, but people wouldn't like fall out, or if they did fall out, it was only a very temporary measure, wasn't it? And do you at this stage of this onboarding process, it's probably too early in the process to address the money laundering regulations at this stage, presumably, or is that something you would want to do at this stage? Does that come later?
Yeah, it does come later. I mean, at this stage, you are building a relationship. You're not
Mhm.
you're not talking about money just yet. So when it comes to anti-money laundering and know your customer, know your client checks,
Mhm.
it's later on, in the process. And
Mhm.
our recommendation is to outsource this anyway to a solicitor. Don't take on the liability, don't take on the burden, just outsource it to a solicitor who's very up to date with, what you can and can't do. And it's just, yeah, it's just part of the best practices that we promote when it comes to raising finance.
And then you talk about nurturing the process of then nurturing and then convincing the investors. So how does that work?
Yeah, so I mean, once you've onboarded the investors, so once you've made sure that they're the kind of person that you would see yourself potentially working with, then
Hmm.
you start the nurturing process. You essentially have a warmish or a slightly cold lead,
Hmm.
and your whole objective, your whole goal is to take them on a journey to get to know you.
Hmm.
And it doesn't have to be very hands-on, from your perspective. You have tools that you can use to make this process as productive as effective as possible. Things like your investor pack. An
Hmm.
investor pack that showcases projects that you've done before. Case studies, who you work with, how your business is set up, what your business continuity plan is. So what happens if if you fall sick or
Hmm.
something, happens to you,
Hmm.
how you communicate with your investors in general. So that's one tool, the investor pack. Another tool could be a newsletter,
Hmm.
maybe a monthly or a quarterly newsletter, which is just a nice and easy way to stay in touch with leads without, again, having to necessarily jump on a call, do a face-to-face meeting, write a long email. It's the one-to-many approach. It's like the scalable way of building a relationship with somebody. So all these things are gonna contribute towards nurturing, building that relationship with an investor up until the point where they're going to be ready. They're going to be warm. They're going to know, all about you. They're going to be super comfortable about who you are, what you do, and they're going to be like, you know what, Paul, I'm ready.
Hmm.
Like, you've answered all my questions. I feel like I really know who you are, what you're about, what you do. So what have you got for me?
Hmm.
And that's when the checks, such as high net worth and sophisticated investors, will take place. And once you start talking about an investment opportunity, also the AML and KYC checks.
Hmm. And this is one of the things that you help people with is the investor packs, isn't it? And I've had like lots of investor packs across my desk, and I think one of the observations that I would have on them is they come as one document and they have like absolutely the kitchen sink in them. There's various different proposals coming at the same time before I really know much about the individual. And then, very often there's too much detail at one stage and then an absence of detail later. It's a big subject and it's not necessarily for today, but I suppose to signpost the audience towards it, this is like your wheelhouse, isn't it? You have a business that, amongst other things, assists people with creating compelling investor brochures.
Yeah, I mean, it all started because we were very disappointed by the investor packs that we were getting when we were
Hmm.
considering investing in other people's projects, and so we started just providing guidance, pointers on how to put a compelling investor pack together.
Hmm.
And yeah, without going into too much detail, look, the first thing is don't have an all-in-one investor pack. Your investor pack is a multiple part document, because if you send a 25, 30, 35 pages long investor pack to someone you've just met, they're not going to read it. It's just like you're asking them like way too much. Like it's way too much of a commitment for someone that you've potentially just met. So the first investor pack, the first part of your investor pack should be a one pager, no
Hmm.
more. Just get to the point. Who you are, what you do, how you work with investors, and get in touch if you want to know more. That's
Hmm.
it. And then the subsequent parts of the investor pack are going to be about building that relationship, showcasing your deals, the deals that you've done in the past. And all the way at the end, it's promoting an investment opportunity. It's you trying to convince someone to invest in a specific deal.
Hmm. Um, Antoine, this has been really, really a useful session. I think a couple of more points I want to deal with, and then I'm going to let you go. Obviously, it's great attracting investors, working with investors, but a key component is retaining them. So, what are your kind of final thoughts in terms of how, once you've secured investments, you've got a great working relationship with them, what are the secrets to keeping these investors for the long term?
The finish line is not getting your investors' money in the
Mm,
bank. This is not the finish line. Okay. The
mhm,
finish line is so far away from you. You know, there's almost no finish line, right? You get the money, you get the investors' money in the bank. It's barely the start, right? Then it's all about providing the right investor updates. The kind of investor updates that investors are actually going to want to read, that
mhm,
provide the right kind of information. And then, we talked about newsletters, so keeping your investors warm by telling them
mhm,
about what it is that you do. So it's all about that, right? Once you've onboarded investors, once you get their money for a project, your next priority should be to retain these investors so that they're gonna reinvest in your next projects. And it's
mhm,
about making them happy, making the investors happy, doing what you said you would. So if you
mhm,
said you would send a monthly update, do send a monthly update even if there's no update, even if there's nothing to talk about, do send an update. Okay.
yeah.
And yeah, that's what it's all about. Retaining, 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 retaining. That should be the priority. And for us, it's the number one test because
Mhm,
a lot of people are really good at getting the money, but they're really,
mhm,
really bad at doing, whatever it takes to retaining you after that. And that's the real test, right? To an extent, like, it doesn't matter how well the deal is going to perform. If you
mhm,
are not good at communicating throughout the project, you will
mhm,
not get our money again.
mhm,
So focus on retaining us.
mhm. Well, it sounds like there's a very important lesson in there. Look, Antoine, this has been fantastic. I really appreciate your time and sharing your expertise with us. I'll just reiterate, that nothing in the podcast has been any form of advice of any kind, and clearly do your own due diligence, do your research. And this landscape changes all of the time. I suppose a final thought to share is in between the time that we booked in this podcast and it's happening, the FCA has interviewed voluntarily under caution various finfluencers, I think they're called. I can't even pronounce the word. Not in the property space, but in other spaces, like for example CFD trading and FX trading and all the rest of it. So if we were to, I suppose, to have just a final cautionary thought, it's right to say that the FCA, regardless of what people might think of them, and they've come in for some criticism in relation to various financial scandals and all the rest of it, but they are watching, aren't they?
They are. And so, yeah, we talked about those finfluencers being interviewed. There are actually some other finfluencers who are going to go on a trial. Um, and yeah, so the FCA is not only watching, the FCA is doing something about it. So yeah, the FCA, as you said, comes under a lot of criticism for the way they've approached certain issues and all that. But um, there's one thing that you can't deny the FCA is doing, and that they're watching and they're
Mhm,
doing something about it. And there's actually public data, there's public releases every quarter
mhm,
about how many interventions the FCA has actually done. So that can be found online. So it's probably best not to be on the FCA's radar. And the best way to do that is to, stay well away from breaching those FCA financial promotion rules that we talked about, which happens to be the way that private investors want to work. So it's a win-win, right? You follow the rules, and at the same time you get great success by following the processes that investors want to follow when it comes to building relationship with you. But yeah, otherwise the FCA is very much watching everything, and best to not be on their radar.
And for the good people who've listened or watched this podcast, and they want to connect with you, like what's the best place we can send them so they can begin to kind of follow you and explore your work in a bit more detail?
Yeah, so two ways: social
Mhm,
media.
Mhm.
So I am on Facebook primarily, but also on all the other platforms.
Mhm.
And the other way is our website, which is theinvestables.com. So theinvestables.com. And you can find out more about who we are and what we do on there.
Fantastic. I shall put those into the show notes. Look, thank you so much for coming on the podcast. This has been as interesting as I thought it would. You're a busy man. I really appreciate and value your time. Thanks very much for coming on. Yeah, it's been an absolute pleasure.
Thanks for having me again, Paul. Yeah, it was a great conversation. Loved it.
So there you have it, ladies and gentlemen, Property and Investor podcast. Please do like and subscribe to the podcast because it makes such a difference. If there's somebody else you'd like me to invite on the podcast, obviously let me know. And in the meantime, please do join me for a breakfast whenever you possibly can. Next, most important one is in January, where we'll be doing looking at goals, and I'll be making some forecasts and predictions as to what the new year might bring. Click on the link below and join me for that. Otherwise, thank you so much for listening to the podcast. Keep well, and we'll speak very soon. Take care.